What's up, everybody? We are on the mobile setup again, and we're getting ready to take a look at the markets, see what went down today. I was really happy yesterday during the pro live stream. We were taking a look at nat gas, and I ended up putting a trade on in there that came in beautifully today. So this was actually what it defaulted to when I popped up. So the move in nat gas, we started looking at it after hours on the initial jump, and it just looked pretty damn strong. So I literally threw in a speculative trade, see how it went, and that was easy enough. So already scaled out of most of it once it fell back below these highs, and I'll leave a little bit of a runner on at break even, which I think this is a little better break even by like a couple cents, not much, but it's to account for slippage. Now, one of the things sometimes when you put on a break even trade after you've had a big rally or something like that, you'll set it up. But then when you actually get your fill, it can be worse, right? Because I use stop market orders. That's how you exit a trade successfully, not a stop limit. That's better for trailing profits and stuff like that. So that's how I account to make sure that I don't accidentally turn the remaining leg into a losing position. So game plan for today is to spend a little time walking through the markets, seeing what's going on out there, and taking a look for some opportunities. Not doing a lot of scanning today, although we can. Then I wanted to jump into a focus topic for today. We have a list of them still to get through, and we have one more trading day of the year. So we are about there. Also, we're in Banff again. We're on our way out. We were actually going to stay in downtown Calgary tonight, but neither one of us really like cities a whole lot unless we're like in that mindset. So we opted to stay back in Banff, actually in the same spot we stayed earlier at the Rimrock, which is a cool spot. It's on like this rim of a mountain that overlooks the whole valley. So the view that we have here is beautiful. Stoked on it. So really great spot to hang out before we head back. So, all that aside, let's see who we have in the chat. It looks like we got Rich. Great to see you, Rich. And let's poke through the markets, shall we? First things first, I need to grab this, and I want to run through a few things. So we also got Dark Mark in the house. Dark Mark, I'm looking forward to the day that you might become Light Mark. Maybe there's a doppelganger or something like that that'll pop through. That would be kind of fun juxtaposition in my mind. And then it looks like here we have here. Rich says, for some reason the pro live streams haven't been showing up for me. You mean on Patreon? If so, let me know. Yeah, so Rich, I'm not sure if you're set up to get the emails from Patreon, but shoot me a email and I can help you troubleshoot it. But the way that you access the pro live streams is through Patreon. So I schedule the live stream through Patreon. You'll get an email from Patreon with the actual link to the post. And that post has the link to the live stream. So that's how you gain access to it. So if you don't have email set up from Patreon, then unless you're automatically going to Patreon to grab it, then you probably would struggle to see them. But yeah, just shoot me an email and we can sort it out. Easy day, no problem. Okay, so taking a look at the broad market, we have a expansion, interestingly, in declining shares across New York Stock Exchange and NASDAQ. NASDAQ is showing a little bit more strength, which is noteworthy to me. And down here, what do I see? Across the board, acceleration to the downside on 5-day, 1 month, 3 month averages, pretty much across the entire board. So the conversation point we've been having for a while now about rotation is very clearly still underway here. That's exactly what I'm seeing. So this looks like The S&P 500 had an okay day today, but still on a gap down. Q's a little bit of a stronger day, I would call it. Small caps, bit of a weaker day. VIX spiking just a little bit, not much. And then bonds up just a little bit. Bitcoin rolling over. I actually added shares to my Bitcoin covered strangle today. Materials, builders down, comms about flat, energy peaking a little bit, financials flat, industrials down, tech down, staples down big. So staples is starting to break out to the downside. So let's take a look at staples. Yeah, this is a breakout to the downside. So this becomes let's take a look, a spot to look for short deltas. So I want to look inside here. I want to look specifically in staples. Nope, that's the wrong one because I'm dumb. And what's happening? Walmart's been super strong. Is Walmart starting to fall? A little bit. Not much, but a little bit. So this is a precarious spot for Walmart. I traded this more to the upside than the downside. I haven't traded this to the downside, but let's take a peek at Walmart. Set an alert there for a downside play potentially. What else looks super weak in here? Walgreens? No, not Walgreens. KC? Cormick? Aha. Aha. This is accelerating to the downside. So this gets an alert. A lot of downside volume. And then we also need an alert down here, but this could be a speculative entry. This is catching something in the middle of a move. So if it continues this downside, which I would favor it to, this looks curious. And what else in here just looks like it's suck and win? Maybe PM? Yeah. These are super volatile. And then if you look at them over, yeah, see, like this is in a bad spot. This starts to become, this is all weak, man. Damn. This is all weakness. Take a look at this. This hasn't had an actual uptick for a month. That's nuts. That's really interesting. Extreme weakness. So most of this sector is just coming undone here, huh? How is CL? This also about to break out to the downside, actually starting to break out to the downside. So this, okay, so after just poking through, and this is obviously looking at S&P 500, right? So we're looking at bigger stocks, and it is just weak across staples. We've known this for a while. This has been the spot to go to fade. But what I'm interested in is that the overall weakness that I'm seeing here is literally accelerating. It's not slowing down. So that tends to mean that we're opening up the floodgates potentially to the downside, starting specifically with this sector. Whether or not that transfers over to broader market and stuff like that, that becomes harder to say. But definitely seeing broad weakness across the board here. That is just without a doubt. So let's take a look at the S&P 500 sectors. And let's go back into staples for some like broad level. Yeah, see? Look at this. Percentage of S&P 500 consumer staple stocks above the various moving averages. 10%, 10%, 10%, 21%, 29%, 29%. Like that's terrible. So this sector is just diseased. This is an easy one either, again, to do what we're doing and find individual names that are running to the downside, or literally to just trade the broad sector to the downside. I would feel completely fine doing that. Because, yeah, that's awful. How's it done on a 6 month? Yeah, 3.98% return in 6 months, bro. That's doing nothing. Now, it's not like energy, which is still getting smashed, but that's still absolutely abysmal. Okay, so really good to know. And the reason why that's good to know is because it helps offset a lot of the different positions that might be in the portfolio, at least for me specifically. I maintain long beta deltas, beta weighted deltas to the S&P 500 via things like UPRO and TQQQs. So I have long, broad market deltas right now. So because of that, it's always nice when there's opportunities to offset some of these deltas, which there's clearly a continuing case for that as it sits. Let me know. It looks like the stream is okay, but I'm getting a thing that says the audio stream's current bitrate is 0. Can you guys hear me? Or am I just talking to myself? I feel like I'm having a great conversation, but it might just be straight up talking to myself. Sometimes I can be my own best friend. Hey, yo, Lauren, what up? Good to see you. Okay, cool. Thank you, Lauren. Ricky says NVIDIA holding on. Funny enough, I flattened on it. So I took the uptick today and I got out of it. And the game plan here is to rotate through it. Mock Chicken can also hear. Same thing with Dark Mark and Tyler Stone. Perfect. So this is just YouTube Studio playing games with me. They know that they can play games with me because I don't know how to stream or do anything like that. So they can pop stuff up like that, and then I'm like, yeah, okay, it's all done. It's ruined. But yeah, this I'm out of here. And what I'll do is probably transition this to a covered strangle. The reason I want to get out of the options is I was given a gift today on the longs. I was able to get out at about a scratch. And then via the shorts, I was able to take those down for a decent profit, obviously, because it's been coming down. So this just looks okay still. Like, this doesn't look terrible, but it's not doing anything. So I don't want to hold it while it's not doing anything, especially with options. This is way more suited to like a cover strangle. So I was already eyeballing 2 different strategies actually in here that we can talk about quickly. I was looking at either trying to capture just time value via in the money covered calls. I'm not a fan of that strategy versus selling puts. I was looking at the call skew and the put skew. And for a little while, this was showing call skew. So that actually becomes a better strategy when it's showing call skew. But it is not often the case that this does that. More often than not, I will see put skew. And I'll show you what I mean. So I was originally looking at the 21 Feb expiry, 21 Feb here. So sometimes, not right now, sometimes you'll see the call side volatility actually elevated compared to the put side volatility. So because that's not the case, though, it's much less attractive to do in the money covered calls or something like this. All the premium is on the put side. So what I would do for this individual product, ticker, I should say, this isn't really a product, is I would sell puts as part of a covered call, and I would capture the put skew because the put skew is fairly pronounced. So for example, these 25 delta, let's say, these 25 delta options, they're at 46.6% vol. And then if we look at 25 delta calls, these are at 45%. So there's an extra point in vol on the put side, which I'll take that. So gamma on these is super light because they're so far out in time. It's only a gamma of 1 and change. Theta, 7 cents a day. So that's probably my game plan to rotate into these. I was actually hoping to wait for a down day. just because I want to see a little more vol tick into those. But that's the plan for an NVIDIA. So the ratio call diagonal is flattened out for today, for literally for those reasons. This little drink, I'm pretty sure it's going to give me diabetes, but is really good. It's called the Betty from Stoke. And it's dragon fruit, pear, apple, mint, lemon, and lime. And it's organic, I guess. Unpasteurized. I don't know. What do you pasteurize? The fruit? Whatever. It's good though. Oh, and there's no sugar added. That's actually kind of sweet too. Well, that was good. Enjoyed that. But you already know what the program is. We have a bubbly ready to go. This one is Dio Peteliante. I don't know what the fuck that means. Bubbly cerise. So my French isn't very good, but we'll figure out what this thing is. Let's see. Cherry. Knew it all along. Knew it from day one. So that's NVIDIA. Let's take a quick look through the coverage triangles. SPY, this is looking at a proxy. Well, not really a proxy for the base of UPRO. And UPRO is starting to look okay to add a little bit of shares, but it's still pretty early. Pretty early. When I see us fall a little bit further from these term highs, then I would be more interested. But this is all part of the coverage strangle in a leveraged ETF. That's what I'm running here. So the high is 609. We are at 588. So we are not far enough off yet. So 609 to 588, that's like a 3% off of highs. So this is okay for short puts. I'll continue to run short puts pretty close to at the money or in the money. But beyond that, nada. So what are we sitting on right now in UPRO? We still have the 17 Jan. We have the 90s and the 88s. Am I in the money on those? UPRO 90s we're in the money on. So let's take a look at those. I mean, they're at the money, so there's not a whole lot that I would do yet. These are running for, this is the problem. They're super wide. Bid-ask spread. I hate that. But these will have to sit and wait because they have tons of time value left. I could roll these out conceivably, and maybe I might. I have to see where liquidity actually ends on these because right now it's $1.70 wide, which is crazy. There's no way that these are $1.70 wide. But I can take these out like 50 days, and I can go out to like the 85s or something like that. Because if you'll remember, this might be from a pro session. I'm not sure where I talked about this last, but we took some of the risk down. So some of the overall position sizing came down in these, specifically because of the way all this was behaving. We did the same exact thing. When I say we, it's the royal we, it's me. I took down from T-triple-Qs for literally the same exact reason. So running the leverage coverage strangle and stuff like this is really lucrative because you're playing on broad market beta, positive drift. You're playing on the volatility premium, specifically that's prevalent in indices. There's a lot of beneficial factors about the strategy and stuff like this. But if you do not scale smartly, you can get decimated really fast. And that is the main weapon you have to make sure that if we have a broad market downturn, you can survive and pivot and continue to have a profitable position. Because like right now in T-triple-Qs, I'm 30% utilized, super small. And then in UPRO, I'm 40% utilized, literally less than 50% utilized in both of these, which is crazy, right? It's really light. And then in Bitcoin, I did add 100 shares. So this is still super light. This is less than 30% utilized, including what I had previously. Right now I have for the coverage strangles. This is for those example accounts, well, not accounts, real money, but for the example trades of trading the coverage strangle and stuff that I was going to continue to update you all on. Right now I have it in TQs, UPRO, and IBIT, and then I'm also starting the one on GME. I have a couple others, but that's not really part of this. The allocations have grown for most of them because I'm looking for these to be slightly more mature positions that I'm going to hold for a while. So they're not, I think I started at like 50K for most of them, or 100K or something. Most of them are a little bit more than that now. And let's see where I got into IBIT shares today. Let you know in a sec. 5387. 5387. And we have the full coverage strangling here. We have short puts, we have short calls, we have long shares, and we have a lot of money left to use here. So this has been an interesting add to the portfolio from a coverage strangle perspective because it definitely has market beta, but it ebbs and flows, which is really nice. You can gain a slightly different style of exposure because of that. So, like, for example, today, Bitcoin was up a little bit, modestly, and the S&P 500, for example, was a very inside day. So this wasn't down a whole lot, it gapped down, but then it wasn't up much, very inside day. So one of the things I like to do is have a couple coverage strangle positions that start to offset one another, not as a hedge, but for non-correlated returns. So I'm actually looking for another coverage strangle to put on to continue that purpose. The tricky part is a lot of the things that I typically would run it in are still too correlated to the market. For example, gold. You can run the coverage strangle in either gold outright. You can run it in leveraged gold ETFs. There's a lot of things you can put it on in, but this is also still too correlated. So one of the big issues with trying to run that strategy as it sits now is finding non-correlated stuff to build the portfolio as I would prefer to have it, especially going into 2025 as it looks like the market is soft. That's still what I see here. Like, this is all very soft. Now, what I don't like is I just review over the movements. I don't like that the down moves are really accelerated. I don't like that the up moves, when we do have them, are on these smaller days like this, The market still is executing that rotation. So having a bunch of broad market long beta weighted deltas right now is dangerous, I think. Now, that does mean looking for things that have had strong moves today is good. So what I do is I pop out in here. We can see that NVIDIA had a good day, but we can also see that energy is starting to decouple a little bit. And we also know that energy has been really punished. So I start to look inside energy to see things like this. And we talked about this literally not that long ago, where there are still stocks within energy that are performing really well. It's in a broader sector that's not doing well, so that's not overall stacking strength. But when you're building a portfolio, it's a process of give and take. So here, there's definitely a bit of both going on, but this is still moderately strong. I don't like that this was a lower low. I don't like that this is a lower high, but this is starting to challenge this lower high. So this could be a pattern starting to turn back around. We won't know yet. The point I'm making is that you can find some sort of strength within energy. And it's not tremendous, but it is there. And it's suitable to offset a broader portfolio. So let's take a bigger peek in energy. We can see DVN is doing okay. Let's see. They had a couple up days, but they're still weak overall. KMI is doing okay broadly. WMB is slow. OKE, big decline, like too nasty of a decline. It's starting to base here, but that's like a really, really nasty decline. CVX, same story. ExxonMobil, same story. Oxy's been getting bid up mostly because Buffett is coming on in there. Let's take a look at VLO. No good. PSX. No good. Citra, a little bit better, but still, that's a deep, deep pullback. Fang, no good. SLB, no good. BKR, don't like that to the long side. Halliburton, maybe? Nope. So really, the main plane here so far is EQT. Hess, nope. EOG, nope. They all look the same. You'll notice as I'm flipping through these, it literally looks like you're seeing the same chart over and over again. So the sector itself is really doing poorly. The only thing that's doing anything in here to the positive side is EQT. So you can either think of it as playing EQT as something that's displaying tremendous strength and propping up the index, but to me, that's kind of like swimming with ankle weights on. Even though EQT is doing well comparatively, it's still being brought down by the broad index. Now, the reason why that matters is from a timing perspective. If we start to see energy rally, things like EQT that have been doing really well tend to lead the rally up and out. So seeing EQT rally today adds something for me to pay attention to. And as always, I have no idea what's going to happen. I don't try to guess what's going to happen. I wait and see what's going to happen. But I pay attention to different potential scenarios so that when something does happen, I'm positioned to do something about it, hopefully making some money along the way. That's the whole point of this game, believe it or not. All right, let me run through a couple alert scans that I got today. These are all things that I get emails from for various stuff. So this is a relative price and volume. So this actually looks like it's breaking out. A little bit early, but this looks okay. It's sponsored by some pretty massive volume. I don't like that it's down sloping on a 3-month though. That would have to really turn that around, but it's hovering near highs, all-time highs it looks like. What's the highest this thing's been? Okay, completely wrong. Not all-time highs, near-term highs. All-time highs are back here, and then back here, I don't know what this stuff is, what it was doing then. So then this looks like the price handle to beat. What is this, 2660, something like that? That's longer term from 2023 overhead resistance at 23. So it's running up against it right now. So I don't love that. That's something I'll keep an eyeball on. There's a bunch of stuff that I've been getting flagged down for consolidations like this. This is heavily consolidating. These I track for pre-breakouts. So I want to monitor the way that these behave. And for those that don't know, the way that I play breakouts is just it's a game of probabilities and occurrences. ASTS, this is bad news. So ASTS is now starting to flirt with falling out of this consolidation zone, which is not good. It's been, well, for those that want it to the upside, because it's been consolidating in there for an extended duration, and now it is starting to break out of this consolidation zone. So that means that a lot of people that were happy buying it before, transacting on it, they're now saying, not so sure. And that's starting to slow down. Sellers are starting to step in a little bit more. So that's something to be aware of. All right. What else do we have from our email? Anything else in here stick out to my eyes? Sats, maybe? No good. MCK's on here, interestingly. No good. DX? No good. ESTC? No good at all. That one's terrible. I made the list. Next. These are a little more selective. Yep. So this is clear breakout. This is too cheap for me to trade, but this is the kind of thing I would put on a paper trade in because I want to follow it and see how it does. But this would be, yeah, look at this, 105 options total and 3 puts. There's literally somebody that has 3 puts in this. So it's impossible for somebody like me to trade this just because I would shift the market against me immediately. There's just nothing in here, but it looks interesting. So unless I want to play the game of just bid myself up, I get to watch this one from afar. CTXR starting to break out, and then there's GUR. Whoa. Damn, look at that. Here's the breakout. Wow. That is strong. So this starts to become more and more delicate the further it goes, but this looks great. 27 against 2, huge call skew. Yeah, this looks fantastic. So this is G trip R's. Good old GUR. Y'all know about GUR, right? Good old GUR. Yeah, that's actually really impressive. That's a strong move. Move this up here. Okay. And let's take a peek through. We have another one. Fiat. How are you looking? Another great breakout. This one's earlier stage. Low. Big volume, big gap. Gap up on the down day, another gap up. Yep, another one that is a little too small for me to trade, but this will be another paper trade. See how that does. Rich says, what are your thoughts on MicroStrategy? In terms of what? We've talked about MicroStrategy a few times previously. It looks like it's dying. I don't like the company. I think MicroStrategy is a glorified Ponzi scheme. And yeah, the only time I traded it was as a leveraged Bitcoin proxy. That was about it. Beyond that, I have no interest in the company as itself. Rich says, seems it's selling off at an accelerated rate relative to Bitcoin. Definitely. So the way that MicroStrategy is literally designed is essentially to be a leveraged Bitcoin play. So it's going to move more than Bitcoin. That's straight up by design. It is exactly how it's going to move. So yeah, I don't really care too much for MicroStrategy. I'll trade anything. So if it's doing something that lets me trade it, I'm down. But like this, trading it to the downside actually looks pretty good. This is a decent way to offset some of the Bitcoin that I have, both the actual Bitcoin, but then also IBIT, if it continues to break down here. Take a look. Yeah, it literally has put skew at this point. So yeah, the market is absolutely punishing this thing, and it looks like it's going to continue to punish it. It should have had a bit more of a consolidation before this down move. This down move was premature compared to what Bitcoin was doing, which is, I think, important because if you look at the movement of Bitcoin here compared to what we just looked at in MicroStrategy, like Bitcoin is having a pullback, but the pullback is still within a broader range that looks generally healthy. If you extrapolate that out to something like MSTR is like already falling out of the primary range that was established. That's not good. That's too much of a pullback. And it's difficult to say, like, whether it's from a fundamental perspective or a market expectation perspective. That part I genuinely don't know. It's very hard to say. But I think most people that are intelligent know what this thing is and the way that it's built. Ever since Saylor was putting out, his manifesto about intelligent leverage, that it literally is a laughing stock for anybody that looks at that has any notion of understanding of how convertible debt works and how that impacts the other participants that are interacting with it. They're essentially financing their movement through other people. And yeah, it's just the late entries are going to continue to get screwed. And sooner or later, that dance comes to an end. So, because I say all that because as an underlying business, it's still shitty. Like, it's not a good underlying business. That's the main thing. If it had a solid underlying business to lean on as it was building a Bitcoin hoard and stuff like that, that's cool. That would give it a lot more space to maneuver, but it's not. The business, the underlying business itself, I mean, take a look at this. We go back 4 quarters, it made 562 EPS. 3 quarters lost 826. 2 quarters lost 762. 1 quarter lost 172. Right? Like, that's just an unhealthy company. So, yeah, overall, don't really like it that much. I still will trade it just because I will trade anything that is tradable for me. But beyond that, it just doesn't look healthy at all. The fact that this thing has put skew is crazy. It's literally crazy. What is IBIT at? Tiny baby options. But still, take a look at IBIT. This is a great example to compare against. IBIT has 1.2 million calls against 682,000 puts. Right? The massive call skew. These are people banking on Bitcoin going up. So if this is the case in something like IBIT, why wouldn't we see that same kind of call skew in MSTR? We should see it here, but we don't because the underlying company is not healthy and everybody knows what this game is. So that is the market telling you, like, clear as day, that this thing is a problem. It's, again, from a trader's perspective, highly tradable. It's so volatile. Take a look at this. 102% vol as a $303 stock, like massive vol. So very, very tradable. But regardless of it being tradable, this isn't something that I would want to be involved with via like a covered strangle, because a covered strangle is designed for longevity. It's designed to be able to hold it for multi-year periods if you have to. This I would not want to do that with. This is something that I would trade in and out of and leave it alone otherwise. Interesting stock, but it is not a very healthy stock in my opinion. Hope that answers some of it at least. Let's take a look at our focus topics. So here's our list. We didn't do one yesterday on the pro session. So if there's any of these that jump out to you guys, let me know. I'm dumping them in the chat so you can pick one. And once I finish dumping these in, then I'm going to go back to just perusing through the market a little bit. So you can poke through those, see if any of them jump out, speak to you, something you want to look at. And in the meantime, let's take a look at a few other things here. I need to continue going through some of these scans. I haven't had a chance to do that today. Let me see. So these are gap downs. Anything in here speaking to me? What is this? This one, VATE. So this looks like it's breaking out downside. An alert to the downside here. MODV. This looks better for like short calls. Pretty flat. What is this thing? Technology-enabled healthcare services, suite of integrated supportive care solutions. Okay. Has options. They don't look good. They definitely do not look good. Damn it. That's not good. Okay. So close that one out. And then let's take a look at this one. This one's looking for big moves up. FFIE is on this list. This still looks just not good to me, to be honest. That doesn't mean it can't rally. It's so cheap. That doesn't mean that this thing can't triple or quadruple in price, but it just doesn't look like this isn't anything that I'm interested in. We have, this has been on a run, Wimmy. That's been crushing it. We already looked at G triple R, Seat. Big breakout, but I don't like the prior resistance. XOS. Nope, too much previous resistance. RCAT is on here. RCAT looks really good. So RCAT gets an alert down here. And then it looks like it's starting to break out. So this is, how did it do on earnings? 18 cents, negative 18 cents. I don't love that for it, but it does look 90 against 33, so big call skew. It's liquid. I mean, this looks okay. And this would be an easy setup. So let's take a look at a prospective trade just to model something since we haven't done that yet. Got all that set up. And stop would be something around 1206. Is that right? That's a little short. Better stop would be here at 1101, but we'll have to see which one of those makes more sense. 1101, 1206. And then 15 is the high. So we'll do just an equivalent probability look. So let's assume something like a 1 month holding. And we need a probability of a touch downside at 1101 we picked. It's a 68% chance of getting hit there. So then let's take a look at a 68% chance over here. 1653. So what do we make at 1653? $16.53 against 1101. Make 168 against 165. That's about fine. Yeah, I don't hate that. Because from a basic perspective, accounting for it on, like a near 1-to-1 move, that's okay. Because my underlying assumption would be that it's not going to be normally distributed and it looks like it has more upside potential. So that's what's being played here. Cool. And I want to take a look at one more, which is just earnings moves. Volume I don't care about. Lateral consolidation I don't care about. Bullish consolidation, we can kill that. Yeah, I want to just take a look at this and see if we've had any big earnings beats for Drift. WGS. There's no earnings here. KULR. No earnings here. Dave. Okay, so this scan is broken. LUNR. I'm going to pop open this scan and see what's wrong with it, because none of these companies have had earnings recently, which is what they should have. So then I don't understand that. It knows that. So then why am I getting an email with stuff in it? That doesn't make any sense. Oh, it's so weird. We'll see if that fixes it, maybe. Because we were just flipping through those, and I was like, this ain't right at all. So easy enough. Cool. All right. So it looks like the focus topic we want to take a look at is when to buy puts or sell calls. Okay, so let's see what the total context is for that one. Where is it at? Here we go. Okay, so this looks like for downside plays. Great. I actually think this is pretty relevant too to what we were looking at before. This will be on 30Ds. And then again, a reminder for everybody, you can access this list of focus topics from my website, so that if you see something on here that looks interesting to you, you're like, oh, I want to understand implementation of stops. One, I have videos about it, but then two, we also take a look at it during the live streams like this. So you can take a peek at it there. But let's talk about when to buy puts or sell calls. This, funny enough, is a really, really easy starting point. And how would you think we can make a decision on whether or not we want to buy puts or sell calls? What do you guys think? The first thing is obviously we have already decided that we want to trade something to the downside, right? Those are both bearish trades. So from there, it's just a matter of dialing in what we want the trade itself to look like and behave as. So there's a couple really key differences between selling a call versus buying a put. So I think we should start with exploring that. So let's grab our scratch sheet. We're going to talk about this one. So let's talk about it. First things first, traits of short calls. And then we'll do traits of long puts later. So let's talk about short calls. What are some of the traits that you can think of short calls? Jason guesses trend. It's a good guess. That will be part of it, but not the natural limiting factor to start. What I want you all to pay attention to as we go through this is if you build trades the way that we're about to talk about it, you start to automatically back yourself into specific option strategies and structures based on your preferences and what you need. So let's take a look. Richard Snook says need shares. Technically in either of these, you don't need shares. So I wouldn't include that personally. The first thing, just think about the basic structure itself. Short calls, defined profit, undefined risk. These are long theta. These are short gamma. See? So then if we do the same for traits of long puts, these are undefined profit, defined risk, short theta, long gamma. This starts to automatically back you into traits, believe it or not. Because what we can do is look at the broader portfolio. And that might help naturally back us into one of these. So the first thing to look at always is portfolio fit. Brick says, don't you need shares to sell calls? Nope, you don't. You can sell calls without shares. So portfolio fit, what does this mean? We've already decided that we need short deltas, right? That's the only reason why we're comparing short calls against long puts. So the other things we can look at in the portfolio is we can take a look at net portfolio theta. Do we have a preference for our net portfolio theta? Do we have a preference for net portfolio risk profile? This is comparing undefined to defined. So what I'm showing you is if we have a portfolio that's full of long puts, it's all long puts, well, maybe we lean towards selling calls so that rather than adding another position that we're paying daily theta on, we add another position that offsets some of the profile of the other positions we have on, meaning not being short theta, having something that actually is providing us theta. So what I'm showing you is that you can back into this decision by first analyzing the portfolio, understanding how these different structures behave and which might fit in your broader portfolio better. Now, we can get to the end of this. We can say, we look through, we know we want short deltas. We know that we don't really care about our portfolio theta. It's fine, whatever that means, whatever's good for you. Here, the portfolio risk profile, meaning not everything is defined or undefined. We don't really have a preference. Then it comes down to the opportunity. So now we analyze what we're trading. So there's two ways you can back into this specific trade that we're talking about. The first way is we have a portfolio need. The second way is via an opportunity. Portfolio need is what we just reviewed together. That's when we look through, we said we need short deltas, okay? So that naturally backed us into short calls or long puts. Then if we had a portfolio need from another metric perspective, theta, undefined versus defined risk, delta, those kinds of things might back you into one of these choices. That's portfolio need. We just went through portfolio need and we said, no, there's not really a portfolio need here. We're good. So then the next is the opportunity. So as we start scanning, not necessarily for short calls or not necessarily for long puts, but we're scanning for things that we're bearish in. Well, now it's based on the individual opportunity. You'll actually notice as we were flipping through a bunch of these names previously, I would say like good fit, not good fit, good for short calls, better for long puts, and it's for a very specific reason. So something like VLO, this is better for short calls versus long puts as it sits right now. And that's because it's already had a big down move. Now it's consolidating. Do we think that it's going to be strong and rally up and out? No, but you can always be wrong. Or do we think that it might break out again to the downside? It might. But right now, what it's been doing for the last week and a half is consolidating. So the reason in this instance I might prefer short calls is because I still think it's generally bearish, not necessarily going to rally a lot, but I don't also necessarily think that this is breaking out to the downside right now since it looks like it's consolidating happily. So in that instance, the better fit here is short calls, because if you bought long puts in this, you're losing money. You need it to go down if you have long puts. With short calls, you just need it to not go up, which is the current thesis here. So there's a couple other things I already forgot what we looked at. Let's see if we can just find something that might be a good example of the other. This maybe. So this, after consolidating for a few days, started to break out to the downside. So for this ticker, maybe we think that it's going to fall to the next point of control, which is somewhere down here, 83 or 82, 72. So then we can compare how much can I make by selling a call versus how much can I make by buying a put if this is my price target. And then I can make the decision based on which one makes me more money. Or the last choice could simply be, I think that this is going to go down a lot for whatever reason. If I think that this is going to go down a lot, you're better off buying the put. Because again, for example, let's say it started to break down below here and we can successfully look back in time. When we look back in time, we can see that it had a massive down move. In this massive down move, where would we have made more money? If we bought a put or if we sold a call? Let's just say when it was trading at 91 compared to where it is today. If we bought a put when it was trading at 91 or if we sold a call when it's trading at 91, which one of those made more money so far if we marked the trade out today? Pretty simple. We would have made way more money with the put. Undefined profit potential. So that's the last piece to answering this question, is based on the opportunity. What fits better? What fits the opportunity better? And this has everything to do with this. This video talks about the outlier trade process. And the outlier trade process is exactly what we just walked through. It's figuring out, do we have a specific thing we need to fit? If not, what do we see and what fits the opportunity best? This is exactly how I personally pick if I want to buy puts or sell calls. Now, there are ancillary details that fit into this. So things like liquidity, things like what volatility is, because there was something else. Wow, what was it? I don't remember what we were looking at. There was something else we looked at just a couple days ago that I really liked it to the downside, but because vol was so high, even though I liked it a lot to the downside, I couldn't rationally think about selling or buying puts because I know I'm overpaying so much for those that it just is not a great opportunity. I forgot what the example was, but we looked at that not all that long ago. I just can't remember which one it is. But that also will be a factor when you're analyzing these opportunities, is what is volatility? Because when we're buying specifically puts, you're almost always overpaying for them. This is because of put skew. So let's take a look at put skew in XLB. If we take a look at this 24 delta, this is terribly illiquid. Let me find something else. Let's try like XLK. This will typically be a little bit more liquid. We'll go the same 53 days out. And let's take a look at, this is also terribly illiquid, whatever. Probably be able to pick it anyways. Do we have anything close to 24 delta? At least we do. We have 24 delta, perfect. So the 24 delta on this is running you 20.7% vol. The 24 delta on this is running you 18.5. So interestingly enough, this is actually inversed. This actually has heavier call skew. So the reason why this might matter is because I might be more inclined to buy the put here because the skew is actually to the call side right now in terms of vol, on these at least, which is interesting. But that's how that factors into the decision, is if we have a slight preference there. So that's how we do it. Fantastico says, don't you need margin to sell a call? It's not like buying a put where you can buy a put. Yeah, that's correct. So when you sell a call, if it's a naked call, you are trading with margin, not trading on margin, you're trading with margin. So you're not borrowing any money, but your broker will ask you to set aside a margin requirement, a smaller subset of money. Reese says, did put skew not used to exist? to this extent. No. It's always existed. Put skew has to be there because otherwise nobody would take the downside risk. So there's always a premium associated with put skew in general. Now, again, there will be instances like we just looked at where it'll actually be call skew, but normally we will see put skew. Reese says in options and strategic investment, his put prices always seem low to me. I don't know which prices you're referring to, and I don't know like what ticker, what the time frame was, but my guess is he's just using different examples, and some of those books are actually pretty old, or like some of the examples he will use, but I'm not sure. Jason says, in your thesis, are you thinking percentage or price based? For what specifically? You're talking the movement in the underlying? Or something else? Rick Noel says, I'm trading options mostly in a Roth IRA. Maybe the rules are different. They are indeed different. So in a IRA account, depending on who your broker is, whatever term they'll call it, you'll have limitations on what you can trade. So you can't sell naked calls, stuff like that. Everything has to be cash secured in the IRA. And then Jason says, yeah. I don't really care about percentages personally when I'm looking at this stuff. What I care about is the price levels based on the targets. So I don't pick targets personally based on percentages. I use raw prices. Oh, it looks like we got our boy back. Hugh G. Could you analyze the good old coin? I think we looked at it a little bit earlier. Yeah, I mean, Bitcoin still looks like it's consolidating. Now, it is starting to show weakness and it's running out of support, I would say. So this looks like as we start dropping below here, it looks like it starts to favor to the downside because just take a look at all the sale volume stepping in here. Massive sale volume stepping in here. So until something decides that it's time to step in front of that, I mean, it's had a pretty significant move. Even from when it was holding above 100K, it's down 8K from that. So it's in a pretty big pullback, nearing an internal correction of some sort. So early to tell, but it looks weak for the time being, I think. That's mostly what I see here. Cool. All right, gang. That's all I got for tonight. So there will be no stream tomorrow because your boy's traveling, but I will be in the Discord most of the day because I will be on Wi-Fi, chilling, and won't have much to do. So if you need anything, hit me up in there. For the pro members, don't forget to sign up for your one-on-ones. And then for the regular pro members, for the mentoring members, sign up for your one-on-ones. And then for the pro members, if you want to book one, you can shoot me an email. I have some availability for this month for those interested. So, as always, great hanging out with everybody. Be an outlier. See y'all later.